I want to quickly talk to you about Schedule E line by line instructions, how real estate investors report supplemental income and loss. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Studio Keyword Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's convo, I want to talk to you about Schedule E. And this is the ultimate guide to IRS Schedule E for real estate investors. And this is a form, the Schedule E is called the Supplemental Income and Loss. It is basically a form that reports on income or loss from several types of business and real estate activity. So the form is filed by the business owner as part of his or her personal tax return on Form 1040. All right. So it's a schedule. It's an attachment to Form 1040. So whether you're a brand new investor trying to do it yourself, or let's say you have $1 million portfolio and have a team of professionals, it's always a good idea to have foundational knowledge, basic knowledge of each aspect of your business. All right. So basically, in today's show, I'm going to really break it down and explain to you what Schedule E is used for. Speaking of which, what is it used for? So this is basically you report supplemental income or loss. Supplemental meaning additional income and loss related to rental real estate. You have royalties, you have S corporations, you have partnerships, we have estates, you have trust. All right. Now, it's very important that I want to talk about the fact that we're talking about supplemental income and loss, not earned income. Okay, so you want to think of earned income as business income, and the earned income is generated from an active trade or business, right? So you pay self-employment tax on earned income, whereas real estate, royalties, partnerships, and S corporations can all generate earned income. That's for sure. For instance, you may actually run a real estate business where, let's say, you are just developing properties or you're flipping properties, where you'll be required to report your income on IRS Schedule C. This is the schedule where you report earned income. Or you may be an owner in a partnership or S corporation and have a commission of earned income and supplemental income. So in this case, what we're trying to say here is that one business can be reported on both IRS Schedule C and E if you have the same business generating earned income and supplemental income. The key here is that supplemental income is also called passive income. That's what I want you to remember here. So when you hear supplemental income and loss and passive income and loss, those two phrases are interchangeable. They are synonymous. So as an investor, this is an important topic because rental real estate generate passive income. As such, you have to report the income and loss from rental real estate on Schedule E. Now, I was telling you earlier that Schedule E was an attachment to your overall 1040. How do those two documents, tax forms, relate? So when you report income or loss on Schedule E, the income or loss is rerouted, is retransferred to different areas within your tax return. Again, folks, everything I'm saying here, I'm explaining to you the foundation of things. Nowadays, if you use tax software, if you use a tax app, everything is done for you. But you have to understand the process behind quote unquote closed doors, if you will. Okay, so your total taxable income or loss is reported on line 26 of Schedule E. So the first and most important place you will see the end result of IRS Schedule E appear is line 17 of your IRS Form 1040. Here you should see the full amount of net income or loss from your rental properties. I mean, I'll go through the form later on, but I'm just explaining to you the basics here, all right? So if your activities on IRS Schedule E, let's say created a profit or a loss, and your loss is not showing up on line 17 of IRS Form 1040, you may be limited by something called the passive activity loss limitation. There are some limitations there. All right. And these limitations actually are kind of complex. So we're not going to go in detail here, but just let me give you a just kind of quick overview. So if your adjusted gross income is less than 100,000, you are able to take the loss reported on line 26 of Schedule E up to a maximum of $25,000 annually. If your AGI is between 100 grand and 150, the maximum $25,000 is slowly phased out. And if your adjusted gross income, let's say, is above 150,000, you cannot claim the passive loss reported on Schedule E unless you're qualified as a real estate professional. Very important. This is very, very important. And I want you to understand this last point. If your adjusted gross income is higher than 150,000, you cannot claim your passive losses against your other income unless you are a real estate professional. So the question here is that, can you deduct your passive losses? So let's talk about Schedule E and passive income and losses. So the thing here is that, as you go through the Schedule E, you will see mentioned everywhere the notion of passive activities. What are those? So most types of business owners actively participate in their businesses, right? But some types of business activities are considered to be passive, in which the owner doesn't participate in the operation of the activity on a regular, continuous, and substantial basis. Those are the three criteria the IRS pays attention to define an activity as active. If it's not active, then it's not regular, continuous, and substantial. Then I'm talking about the owner's participation. If that participation is not regular, continuous, and substantial, then we have to revert to the passive income definition. So passive activities are taxed differently from active participation, and this difference comes into play in Schedule E for both real estate activities and activities of partners and S corporation owners. So the IRS considers rental real estate activities as passive even if the person materially participates. So some partners and S corporation owners have limited roles in their business, and consequently their losses are limited, right? So the difference between passive activities and material participation is most important when it comes to losses. Why? Because losses from passive activities may be limited. I was talking to you earlier about the passive loss limitation, right? So having said that, losses for individuals who materially participate in their businesses are not limited. Okay. Now, so you may not be able to deduct your passive losses, and the thing here is that a lot of investors, a lot of real estate investors, are kind of worried they can't actually deduct their losses, and that is true because the regulations and guidelines from the IRS are a little convoluted. And if you want, you can actually read more about this on Form 8582. This is basically this is what happens when you have losses that are not approved. The IRS has the funny term unallowed loss, and this is where you actually report. You go to Form 8582 to report your unallowed losses. All right. So this is the thing. So people constantly think, well, real estate is a beautiful way to shelter income from taxes. But when the truth hits, they're kind of like, okay, wow, this is crazy. They realize that they are being barred from taking the well-deserved losses because there are rules in place. I want to talk to you also about an important concept when it comes to Schedule E. We have property basis and depreciation. Folks, before I get into the nitty-gritty of the line-by-line instructions, I want to make sure you understand the concept we are going to talk about. All right. So one of the most important parts of preparing IRS Schedule E is making sure that you understand and you can calculate the rental property cost basis. So the thing here is that, what is the property basis? So you have the right tool or calculator. Again, nowadays, if you input the right data into your tax software, everything will be done for you. But there are three important elements that will help you when it comes to analyzing your closing cost and depreciation. You're going to need the property basis, the loan cost basis, and the currently deductible expenses. Let's talk about those. The property basis. So this consists of the agreed upon purchase price plus closing price like title insurance, transfer taxes, inspections, appraisals if paid outside of closing. You have travel cost, attorney fees, and notary or bank fees. From the property basis, you just subtract out your land value to determine the total value in which you will begin depreciating. And this is called the depreciable basis. So think about it, okay? So purchase price plus closing cost minus land value equal depreciable basis. So depreciation will usually be over a period of 27 and a half years. And if you are investing in commercial property, you are looking at a 39-year period. And basically, there are several depreciation methods and conventions. And you'll be using the modified, the makers, so the modified accelerated cost recovery system for your depreciation purposes. So besides the property basis, we have the loan cost basis. And this is the sum of all costs associated with the loan. So this can be the origination fee, the credit report, the bank fees, and appraisal fees if one was required by the lender. So once you calculate the loan cost basis, you need to determine your annual amortization, right? So basically, when accountants talk about amortization, it's basically the same thing as depreciation. It's just that the depreciation method is the depreciation method for intangible cost. Intangible means things like patents, anything that is not tangible, non-physical cost. All right. So you also have the currently deductible expenses. So I'm talking about hazard insurance, property taxes, and other miscellaneous expenses. So these expenses do not need to be amortized or depreciated. Okay. But they're simply deducted in full the first year. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We are still having a walkthrough into Form Schedule E line-by-line instructions. But before I get into the line-by-line, I want to make sure that I explain everything to you before we actually start the process of filling out the form. So how do you report rental property on Schedule E? So the thing here is that the first section it's seemingly the easiest. But the thing here is that it really trips plenty of folks up. First, you have to determine whether or not you made any payment that required a 1099. So as a general rule, you must issue a 1099, and these days it's called 1099.nec, 1099.nec. You must issue this to contractors whom you've paid over $600 for work during the year. Folks, $600, that's the threshold. That's the floor, rather. So starting in 2018, if your rental activities rise to the level of a trade or business, you will need to issue 1099s to vendors. So let's say if you are a landlord with rentals qualifying for the IRS Section 199A deduction, you need to tick the yes box when asked if you made payments that require a 1099. Otherwise, you need to tick no. I'll go through that later on. And you also need to mention whether you have the kind of property you have, single family, multi-family. And you also need to determine the fair rental days, things like a personal use days, and whether or not you are operating a qualified joint venture. This is kind of important. And one thing that I want to mention here is that you need to understand that a qualified joint venture most often occurs when two spouses own a property 50-50. And not just that, they do not live in a community property state. So I'm talking about Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. And the thing here is that if the spouses of a jointly owned rental apartment live in a community property state, there is no need to worry about or elect the qualified joint venture status. And the thing here is, and this is kind of important because when rental property is jointly owned by spouses who are not located in a community property state, there is a problem. Why? Because the spouses must either report their income and losses on a partnership tax return, which is kind of complicated. It could be very complicated here, or they can elect the qualified joint venture status. So if you want to read more, just go to the Schedule E instructions in terms of the qualified joint venture status. So, how do you report car expenses? The thing here is you can actually report car expenses. You need to use another form, 4562. All right. If you want to claim those beautiful IRS deductions, you can do that. So you can either do it, or you can actually just you can just claim the IRS standard rate of 57.5 cents per mile in 2021, and in 2020 rather, and 56 cents per mile in 2021. But if you want to go the long way, you want to do you want to itemize things, then it's important. Now, first thing first, if it's not documented, you cannot take the deduction. You want to document everything. You want to keep the paper trail of everything. Very important. And so many tax advisors will recommend using the actual expense method, in which you record all of your car expenses incurred throughout the year and deduct the portion allocable to the business use. However, it's very important, and we've seen this before. It depends on your operation, on the size of your operation. It's important to have a good idea of payoff versus efforts. What's the opportunity cost here? How much do you have to sacrifice to be able to track maybe expenses that only amount to 0.5 or 0.2 or 0.1% of your total activity? Think about that, right? So you have to think about it, whether or not the method you choose simply is not worth your time. Okay, and what you have to really understand here is that you want to spend some time estimating your annual deduction using both the standard mileage rate and the actual expense method. And you need to determine upfront which method will likely yield higher results. So the standard mileage method, as I said earlier, is great because it's very easy to track and takes no time at all, thanks to great smartphone apps like MileIQ. We have actually devoted an entire show on mile tracking apps. You might want to double check that show. It talks at length about the cool features and the traceability, the monitoring that you can do with those apps. Fantastic. All right. And one thing I want to say here is that at the end of the year, if you want to go with the regular route where you actually itemize all your expenses, you will need to compile all of your car expense documentation and report it on page 2, part 4 of IRS Form 4562. Okay, and the total expense will then flow to IRS Schedule E as an auto expense. I want to also talk to you about the key Schedule E forms for different businesses, because again, simply because you're filing Schedule E doesn't mean that you are automatically a partnership or a C Corp or an S Corp. No, all kinds of businesses can file Schedule E. So Schedule E basically records income and expenses from real estate activities, right? And those are considered, as I already said before, passive activities. So you receive income from rental activities mainly for the use of a tangible property, a rental property, for example, rather than for services. So the designation here, the designation of a rental income as passive has several implications for you as a taxpayer. So you have deductions or losses from passive activities are limited. I said that before, to $150,000. And because your rental income is passive rather than active, you're not considered self-employed, and you don't have to pay self-employment tax. Here, this is self-employment tax. That's the Social Security and Medicare tax on that income. So what about Schedule E for partnerships and S corporations? The Schedule E is used to report income for individual partners in a partnership and for owners of S corporations. So the income of the business for the year is calculated, and the profits or losses are distributed to the owners in the form of a Schedule K1. And this information on the individual owner's income or loss is included in Part 2 of Schedule E. And remember that the Schedule E is not used to report rental real estate activities for partnerships and corporations. So Partnerships and S corporations use Form IRS Form 8825 to report rental real estate income and expenses. Now, what about Schedule E versus Schedule C? I think I kind of explained that a little bit before, but I want to do a little bit on it. So whether you must use Schedule E or Schedule C to report your business tax situation depends on the activities of your business. So in general, let me give you a general rule here. If you rent buildings and provide basic services such as heat and light, trash collection, etc., you want to report your rental income and expenses on Schedule E, Part 1. If you provide what the IRS calls substantial services, mainly for your tenants' convenience, you want to report your rental income and expense on Schedule C of your Form 1040 or Form 1065 if your business is a partnership. Okay, so the IRS says that you are considered to provide services for occupants if the services are primarily for their convenience and are not services normally provided with the rental of rooms for occupancy only. So substantial services include such things as regular cleaning, right, maid service, and changing linens, but not furnishing heat and light, cleaning public areas, trash collections, and more. So providing substantial services and being considered a business owner also means you might have to pay self-employment taxes on this income. All right, so let's say if you're running, for example, if you're running an Airbnb type home sharing business with no substantial services provided, you would use Schedule E to report your rental income. And if your Airbnb business involves substantial services like breakfast, it would be taxed as a business. So this is very important to understand, okay? And you might need to use Schedule C to report this income and expense. So let's just talk about the income and expense items that you should report on IRS Schedule E. There are a few of them, and you got to be. I want to make sure that you're claiming all the credits that you deserve, all the write-offs that you deserve, and that you don't leave no dollar on the table. Don't leave no cash on the table to the IRS. So there are a few of them. All right. The expenses are where the tax avoidance, the legal tax avoidance strategy comes into play. So let me kind of quickly give you a roundup of those things that you need. So advertising. So you want to include all general marketing and advertising costs. Auto and travel. So you want to include all ordinary and necessary auto and travel costs required to maintain your rentals. You have cleaning and maintenance. So all expenses that you use to prepare a unit for a tenant or once a tenant moves out. Commissions. So if you have a realtor or property management commissions paid to find a tenant for your unit. Insurance. Here I'm talking about homeowners, hazard, and flood insurance. Do not prorate your annual insurance. You will only report the amount of insurance that you actually pay to your insurance company, not the amount that you pay into escrow. You have legal and professional fees, right? Things like attorney fees, accounting and cost of business financial planning related to your rentals. Management fees. So you have the cost to hire an agent or property manager to manage your rental. And this may also include special service calls that the property manager incurs to check on the rental. Mortgage interest paid to banks. So you want to put that also. And this is basically, you get this on Form 1098. And other interest. So this actually amounts to the money you pay to third parties, whether they are private investors, private businesses, crowdfunding platforms, or P2P sites, right? Repairs also. So all repairs made to the property that were not considered capital improvements can actually be written off. So I'm just talking about small repairs and not the replacement of full or floors, roofing, because those will be considered capital expenses. Supplies also you can write them off. So the cost of materials and supplies such as paper for printing, small tools, and other small miscellaneous materials that don't fit into another category. You have taxes, so you include all tax expenses incurred as a result of owning and operating the rental property. So I'm talking about property taxes, school district taxes, and special easements or land taxes. Do not include income taxes. You can also write off utilities, depreciation expense, and others. So here, everything else that is not in the categories that I've mentioned above, you can just write them off. I'll be right back right after this. Don't go anywhere. All right, now that you understand everything, I'm just going to quickly start the instructions, the line by line instructions in earnest. So I want you to pay attention to the screen as we walk through. So remember that Schedule E lists specific types of income considered as supplemental, from rental real estate, royalties, partnerships, and S corporations to estates, trust, and what they call the remix. And the instructions here that I'm going to talk to you, they focus on Schedule E to report income or loss from partnerships, S corporations, and rental real estate businesses, including home sharing and Airbnb types activities. All right. And so the guidelines I'm telling you here do not include real estate professionals, but rather properties you own as an individual, partnership, or corporation, and from which you receive income and have expenses. All right. So for estates and trusts, you can find information from the IRS about Form 1041. This is the income tax return for estate and trust. And corporation don't use Schedule E at all because it's not part of a corporate tax return. And corporation owners are shareholders whose income comes from dividends. So this is a distinction to be made here. And sole proprietors and one owner LLCs do not use Schedule E because they report business income on Schedule C. So before you complete Schedule E, you want to actually gather all your paperwork. All right. So as I said, this is something you have to have all your paperwork ready, and you have to have all your receipts, all your financial statements, your profit and loss, your balance sheet, and your cash flow statements. So let's talk about part one. So as you can see right now, we're showing you the Schedule E on the screen. So you put your name, you put your social. And part one, this is where you actually put the income or loss from rental, real estate, and royalties. So you put you put A to answer whether you made some payments in 2020, and if yes, you have to answer whether or not if you filed a Form 1099. I think I spoke about that before. If you paid someone more than $600, so you put the physical address of each property. So if you have more than 3 properties, we have line ABC here. If you have more than 3 properties, you actually have to attach. You have to attach to the form another document, another paper, another sheet rather. So 1B, you put the property here, you put the fair rental days, the personal use days, and 1B ABC, the type of property you need to mention what it is here. And moving on, we have here line 3, you have to put rent received. Line 4, you want to include royalty received. Again, you have to do this for each properties ABC. If you have more, you have to attach the separate piece of information. So for the expenses, advertising all the way to depreciation, I just went through that. You put all the expenses in the right column, and you add them up, and at the end, so you have from line 21 to line 24, 25, it's pretty self-explanatory, and line 26 is actually the total rental, real estate, and royalty income or loss, and this is what you have to put on Form 1040. So basically, the thing is that once you have all the expenses inputted into your IRS Schedule E, you add them up and subtract them from your gross rental income. So the income or loss for each property will be reported on line 21. Okay, so if line 21 is a loss, you put in line 22. The thing here is that, as you can see on the screen right now, line 24, this is where you show the total net income each property has produced if each property showed net income. Remember that your losses may be limited due to the passive activity loss rules, right? All of that information will be reported on Form 8582. So you want to definitely review that form if you're showing rental losses. And one thing I also want to say is that line 26 of the Schedule E will show the total income or loss that will be reported on line 17 on Form 1040. Okay. And one thing I also want to see here is that partnership, and this is kind of important, partnerships and S corporations will provide you with an IRS Schedule K1 at the end of the year. And that information will be reported on part 2 of IRS Schedule E. I'll talk about that very soon. And basically, we're reporting the name of the partnership, whether it is a partnership or an S corporation, whether it's foreign owned, and what the employer identification number is. All right. And the one thing you have to understand is that entities must go through the same type of reporting we're doing here with the IRS Schedule E. And so, the businesses and organizations might use different forms, but they are reporting the same information and then providing that information on a summarized form, which is a K1, the Schedule K1. All right. So if you are a partner, let's say you have not received IRS Schedule K1, but you have an ownership stake in a partnership on an S corporation, you have a couple of options here. A couple of options. The easiest thing to do is to file an extension and wait to file your returns until you actually receive the Schedule K1. This is option number 1. Option number 2 is to go ahead and file your returns and then file an amended return once you receive your K1. So those are the 2 options you can actually choose here. So I want to dig a little bit into part 2 here. So part 2, as you can see on the screen, folks, this is where we have the partnerships and S corporations, right? So again, here you just have to put your name and your social. And then you have to actually, on line 27, you have to respond whether or not whether you're reporting any loss not allowed in a prior year due to the at-risk or basis limitations, a prior year unallowed loss from a passive activity, or unreimbursed partnership expenses. So it has to be yes or no. And if you answer yes, you need to actually see instructions on form on the supplemental income and loss form, Schedule E, before you go further. So you have to put the property, you have to put for ABCD line 28, you have to actually put the property, you have to enter P for partnership and S for S corporation, and you need to check if the partnership is foreign. You have to put the EIN for each property, and you have to check in column E. You need to check if you are requiring a basis computation, or and in column 7 whether the amount is not at risk. And then you have the passive income and loss and the non-passive income and loss. I think I've spoken about that, the distinction between passive income and non-passive income. So if your business is a partnership, multiple member LLC, or S corporation, there is a 3-step process to reporting your income as a partner or owner. So step 1, you have to calculate and report business net income. That's the step 1. We already talked about that. So remember, the partnerships and multiple owner LLCs calculate and report business income and expenses on Form 1065. And on that form, they show total income, expenses, and net income. In other words, the profit. And this includes income from rental real estate reported on Form 8825. And then you also have S corporation, which calculate and report business income and expenses on Form 1120-S. So the step 1 is to calculate and report business net income. Step 2, you want to separate out income, deductions, and credits for each owner, depending on the written agreement for each business type and whether the income was passive or non-passive. And step 3, you need to prepare a Schedule K1 for an individual owner with the information included on Schedule E. And basically, the Schedule K1 shows the individual's partner's share of ordinary income, rental real estate, interest, dividends, royalties, short-term and long-term capital gains, other income or loss, Section 179 deductions, other deductions, and self-employment earnings and loss. And there are actually 2 versions of Schedule K1. So you have a Schedule K1 Form 1065 for partner share of income, deductions, and credits. And then you have Schedule K1 Form 1120 for shareholders' share of income, deductions, and credits. Okay, we're still on we're still doing the line by line instructions on Schedule E here, and I want to talk to you. So I spoke to you about part 1. Part 2 was partnerships and corporations, right? And part 3 and 4 here, we have part 3 and 4. We have so on the screen, you can see on the screen right now. So part 3 is income or loss from estates and trusts. And again, here this is pretty straightforward. Every year, according to research, less than 5% of the Schedule E's filed with the IRS are from estates and trust. So here on line 33, you put the name and the name of the estates or trust, and you put the EIN. You sort of indicate whether we're talking about passive income and loss or non-passive income and loss. And you put the total. You total everything on line 34. And line 35 is pretty self-explanatory. And on line 37, this is where you actually put the total income or loss from the estate or trust. And you do this by combining line 35 and line 36. So that's for part 4. And part 3 rather. Now part 4, it's the income or loss from real estate mortgage investment conduit, the remix. And this is if you are a residual holder. So it's only one line here. You put the name, the employer identification number. You have to actually put if there is an excess inclusion from Schedule Q, line 2C. The Schedule Q is another complicated form that I'm not going to cover here in detail, but it's important to know if you are a REMIC. And that's it. So for you just on line 39, you put everything. You combine column D and E, and you add everything, and you see the results, whether you have an income or loss. And so part 5, it's really the summary. So what you do here is that you on line 40, you have the net farm rental income or loss from form 4835. Line 41, you put the total income or loss. This is where you add all the lines. So 26 to line 26. If you go back and look, line 26 was what? Was the total rental, real estate, and royalty income or loss. And then you have line 32. Line 32, that's the total partnership and S corporation income or loss. And then you have line 37. This is the total estate and trust income or loss. And line 39, that's that's for the REMIC, the total income or loss from the REMIC. So and line 40, which is the net farm rental income. So you have to add those 5 categories of passive income, and you put this on line 41. Okay, and then you transfer afterwards to schedule 1, form 1040, line 5. And then in 43, you do a reconciliation of farming and fishing income, and line 42 rather, and line 43, you have reconciliation for real estate professionals. So this is basically it, folks. This is basically the what you need to know about Schedule E, line by line instructions. All right, folks. Thank you so much for your attention today. I really appreciate it. I'm going to quickly recap what we spoke about today. I spoke to you about what is Schedule E used for, how does Schedule E interact with your overall 1040, can you deduct your passive losses, how to determine property basis and depreciation basis, right? How do you report rental property on Schedule E? How do you report car expenses? What are the key Schedule E forms for different businesses? Which income and expenses should you report on Schedule E? And I gave you all the instructions, the line by line instructions. Thank you so much for listening, for your attention. Really appreciate it. I'll see you next time. But until then, remember, stay marvelous.